With mortgage rates starting to fall and a possible Fed rate cut on the horizon, many homeowners are going to begin asking when they should look at refinancing their mortgage. Should you do it as soon as rates fall below where you are, or should you wait to see if they fall even more? Well, good news. I am here to answer all of those questions and more. Now, if you own a home, then this is going to be something that's going to be of interest to you. But most of you guys out there listening are realtors, and I'm sure most of you do own your homes. But if you don't, this is still important for you as well. Look, I do this each and every week so you guys can better help your clients with all of their real estate needs and be their go-to source for all things homeownership. And interest rates and refinancing is just one more piece to this real estate puzzle. So the more you know about how it works, the better you position yourself as an expert in your field. All right, first off, what kind of refinances are there? Well, there's rate and term refinances, cash out refinances, streamlined refinances, and home equity lines of credit or second liens. Today, we're mostly going to focus on rate and term refinances. I've talked about all the others in past episodes, and I'll dive more into this topic in the coming weeks. But a rate and term refinance is just what it says.
Oh, really?
You're refinancing your loan to get a different interest rate or a different term, like going from a 30-year term to a 15-year term. Now, if you have a VA or FHA loan, you have the option to do what's called a streamlined refinance, which is basically the same thing, but it just has fewer requirements and lower costs related to obtaining the new loan. Again, I'm going to cover this in greater depth in the future, but it's just another version of a rate and term. So how do these refinances work? And more importantly, when should you look to do a refinance? So first off, the requirements are basically the same as they were when you got your loan original. Again, streamlines being somewhat of an exception to that, but more or less, you still have to have your credit pulled. You still have to have a debt to income ratio that fits the loan program. However, in most cases, you will not need to pay much of anything out of pocket to do this if you don't want to. And oh, by the way, you can do any kind of refinance with any mortgage lender you want.
Interesting.
You see, there's a common misconception that you have to do this with your current lender, or that you'll even get an easier or better deal if you go with that current lender. When in fact, in many cases, you might get a worse deal when you work with your current servicing bank than if you called and talked to other lenders. You see, the bank that already has your loan in their system knows that you're not likely to shop around because it's easier just to call them. So they'll often take a little bit of advantage of this and maybe give you a slightly higher rate than you could have got if you just shopped around a little bit. All right, so a borrower completes an application, has a conversation with their lender about rates and costs and payments. Then the lender collects the necessary documentation. You might have to order an appraisal. This is always going to depend on several factors like your loan to value, how much you owe versus how much the house is worth. It also depends on what type of loan you're doing. And honestly, if the value that your lender puts in the automated underwriting system is accepted by the algorithm. You see, getting that appraisal waiver can be a bit of an art in some cases. So make sure your lender has had some experience doing these things. Then, as long as everything lines up and your value is good, then you can often roll all of the closing costs into your new loan. Yes, there are still costs. There are never loans that get done without costs, regardless of what the internet and advertising tells you. There are title fees, credit reporting fees, possibly appraisal fees, recording charges, et cetera, et cetera. And if you think that a lender is going to do a free refinance for you because you're just such a great guy or gal,
What do you mean?
then I've got some oceanfront property in Arizona that I'd like to show you. So there's always costs. It's just a matter of who is paying the cost, you or the lender on your behalf. You see, your loan amount may not increase by the amount of the costs like it does in many streamlines, but that just means your rate is most likely higher than it would have been if you had rolled the costs into your loan instead of electing a quote no cost loan. You're going to pay for it somewhere.
God damn it.
Whether it be in the actual costs or a slightly higher rate than is otherwise available to you. Now, the real question is, when does it make sense to refinance? Now, here's where figuring out all this might actually be easier than you think, because for a rate and term refinance, it's actually a pretty simple formula to decide if now is the time to refinance or if you should wait. You see, all you have to do is take your old payment and compare it to the new payment with the lower rate. If you save enough on the new payment to break even on the costs associated to doing the new loan in less than 3 years, then it's probably time to pull the trigger. Now, there are a couple extra things to consider here, though. If you're moving from a 30-year loan to a 15-year loan, your payment is most likely going to go up, not down.
Why?
Because of that shorter term to pay off the mortgage. And figuring out the math on if that makes sense takes a little bit more data about the interest savings over time and then the cost incurred. Also, if you're doing a streamline for an FHA or VA loan, then there's no cost added back to your loan. They can't. And in that case, it almost always makes sense. You just might want to check and see what the rates look like if you didn't do the streamline and added in the cost of the loan instead. You might actually get a better deal in some cases. And the last thing to consider outside the basic formula formula is where the overall interest rates are headed. Are they going to continue to decline? And is right now a little bit too early to refinance? So how do you know if you should wait? Well, if you listen and follow this podcast, I help answer that question each and every week. But otherwise, you need a knowledgeable, experienced lender to help you gauge where rates are headed, and if now is the best time to pull the trigger, or if you should wait just a little bit longer. Now, other than those circumstances, if you subtract out the costs of setting up your new escrow account, this is where your taxes and insurance get paid out of. You see, you do this actually because your current escrow account gets refunded back to you after you close and pay off your old loan. It's almost kind of like a little mini cash out. It is your money, and that money is just being put into your new loan, but you don't need to do anything with it because you have a new escrow account that's already set up for you in most cases. So you can just keep that check that you get back from your current servicer and do whatever you want with it.
Here comes the money.
Here we go. Money talk.
Here comes the money.
Also, you get to skip at least one mortgage payment. And if you do it right and time it correctly, you can skip two. So you take the total costs, subtract the escrow setup, and divide it by the amount your mortgage payment is coming down. And if that number is less than 36 months or 3 years, then you are golden. So if your total actual loan costs were say around $7,000 and you were saving about $200 a month on your new payment, that number comes out to 35 months to break even on the cost. So if you aren't planning on moving or selling in the next 3 years, then this is an absolute no-brainer. Now, if that number comes out to 3 to 5 years to break even, then it becomes kind of a personal preference at that point. If you know for sure that you aren't planning on moving anytime soon or doing anything different with your home situation, it could still easily make sense. However, if it takes more than 5 years to break even on the cost of this refinance, I would say that it absolutely does not make sense. And the reason is that 5 years is just too long of a time horizon to know where life is going to take you. So in that case, it's often best to wait until the math makes more sense. And that's it. Pretty simple stuff. Now, if you have questions about any of that or want more information on how all the other refinance programs work, give me a shout. I'd be happy to walk you through all the options. And trust me, you can find my contact information pretty much anywhere on the internet. So give me a buzz.
Hello, shorty. What are you doing?